70% of his portfolio in an index annuity. And he gave me all the sizzle, right? And I said, okay, let's talk about this a little bit. And I said, what's in terms of what the annuities can do. No, hold on a second, Pablo. And then I said, no, let's look at it a little bit deeper there. And he said he'll research a little bit more and get back to me. And I'm not against index annuities. I just want to be clear, but I think a lot of people don't know quite what they're getting. They hear the sizzle, but they don't know everything else. So Amar, do your intro here so we can make sure we're being fully disclosed.
Yeah, so if you could share the slides and then we can go through those.
Sharing this. Hold on a second. I got to add this. How come I can't add it all of a sudden?
There you go.
Yeah, but I want to get where we're both. There we go.
All right, there we go.
Yeah, or no.
All right. So here's our disclosures. Whenever we talk about annuities, I think like the first thing comes, oh, that's a commission product and it only helps the advisor, blah, 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 blah. I just want to put it out there before we get started in any of this, is that we're a fee-only firm. We're a fiduciary. I have nothing against people that sell annuities that make a commission, right? But for those that are extra sensitive to that, we don't make a commission. We're a fee-only firm. So this is just advice and talking about the landscape. So today, my goal is to kind of talk about the interest rate environment and today's scenario in terms of retirement portfolios and what retirees are facing. Want to talk a little bit about, there are a lot of new tools to compare annuities. I think when we get to that part, we can talk a little bit better about how transparency has increased in the industry over the years, right? And then I want to give an example of a fixed index annuity.
Good.
And that's just one type of an annuity. Right. There are many different types of annuities, and this is just one slice of the pie, if you will. And then maybe some key takeaways and things that you can ponder and how this may apply to you, right? So let's go from here to kind of where the interest rate environment is. I think if you look at the slide, I think there should be two key takeaways. The first key takeaway is that yields have traditionally been between 3 to 6% over half the time throughout history, right? So this is interest rate yields from 1870 to up until last year. And you can see for the most part, interest rates have stayed between 3 to 6%. The second thing is that if we look at the last decade or a little bit more, we've had all-time low interest rates, right? And low interest rates have fueled this 13 years of a bull market in the economy, partially fueled the bull market in the markets. But if we step back a little bit more, since 1980s, rates have been coming down. Some have said we've hit a bottom point, and now we're moving up. The key here is nobody knows where interest rates are going. Nobody has a crystal ball. I have this really cool magic 8-ball. Shake it to tell me what it says, and it says it's definitely not certain. And I didn't rig that to say that, but the idea here is there is interest rate risk, there is market risk, and for individuals in retirement trying to reduce risk, one of the things that they look at is spreading that risk and transferring that risk to an insurance company, right?
Exactly.
And that's exactly what annuities do. So they provide protection and income-focused solutions that are appeal to retirees in this type of environment where they want to transfer the risk to another company. And how insurance companies work is they pool the risk amongst thousands of people, and they're betting to 50% break even, and then they try to get the odds to be slightly north of that. Just want to take a moment before we go to the next slide and just say that pension plans large pension plans are exactly what traditional annuities do in terms of they're pulling the risk of hundreds of employees and they're looking at longevity and different factors to see what they can, how can they get a blended higher payout for an individual with all the associated risk.
That's always made me laugh, Amar. Like Ken Fish and these guys, annuities are bad. And you're like, well, what is it a pension? I mean, literally the same people saying, I love my pension, but I hate annuities. I'm like, man, it's just okay. It doesn't. It's not logical speaking there.
Yeah, and from a planning perspective, I think it's really important to know that some of your expenses in retirement should be covered by a guaranteed source. They don't have to be, but they should be. And how much should they be covered is how much risk you want to take on. So it could be as low as 20 to 30%, 40 to 50%, but some range that you feel comfortable with should be covered. It helps you sleep at night. I mean, I think that's a big part of maximizing your ability to enjoy retirement is not to stress about money all the time, right?
Couldn't agree more. Absolutely.
So what are annuities? So annuities basically have, it's a package product that has two phases. One is considered an accumulation phase, and the other phase is considered a distribution phase. And really what the distribution phase does is that it pools a risk amongst thousands of people to address longevity risk, right? And so the insurance company can guarantee a certain amount of payout when it pools that risk amongst thousands of people, right? Annuities have had this bad rep of being complex and very expensive, but in the last decade, I would say they've created new products that are simpler to understand, and they have value in terms of the benefits and riders that they provide. So regulation, technology are also making the availability of the information a lot more to everybody. So one of the things that annuities were created for was to help manage the impact of sequence risk.
Exactly.
Right.
Exactly.
So
anyway, you can make that bigger. Can I make it bigger?
No, I tried, but there's no way to make it bigger. The key point here is that you could take two people with the same portfolio and retire them at two different periods of time, and their outcomes can be totally different, right? I mean, and that's because of sequence risk, because if the markets are going down and you're withdrawing at the same time, that has a lot larger impact on your portfolio. And so one of the things that we talk about with clients is, what is the stress on your portfolio, right? At this given point of time, what is your withdrawal rate, and how does that factor into the risk of your portfolio, right? Tools to compare. So there are a lot of tools to compare, right? Nowadays, you can go online, you can talk to a broker, you can talk to an insurance agent or an advisor, and they can create, they have tools to create comparisons from different product series, right? And so the thing to keep front of mind here is that annuities have been evolving. There are now ways to compare annuities between each other. And I think there are several factors that you want to compare. One is how long of a hold period you have, the duration that you have to hold that annuity. There are now annuities that have zero duration risk, meaning that you can buy an annuity today and you can sell 100% of it tomorrow, and there's no surrender fee. There are annuities that could go up to 10 years, up to 15 years, right? So like there's all these different variables that now that you can compare. The other thing that you can compare is liquidity, meaning if you do have to take a withdrawal, are there surrender fees associated with that? Are there penalties that you may face by taking more than 10%? And what are those penalties? And what does that schedule look like? Some companies, Josh, I don't know if you remember when we were at USAA, but it was like 777.
Yeah. 5.2, 777, 776, 5.2. I remember 5.2 in year 4.
Yeah, I don't know, like so like, and then some companies go 8, 7, 6, 5, 4, 3, 2, 1, right? So there's different, you're going to want to use that as a comparison because you never know what's going to happen. And there may be a chance that you have to take an excess withdrawal, right?
Mar, I
So,
looked at some annuities the other day, and they had no withdrawal fee for the first 5 years, which is actually what you want, frankly. I mean, literally, you don't want it. But I was like, wow, I had never seen that before. No withdrawal, not a withdrawal fee, but no withdrawal ability is what I'm saying. It's completely illiquid for the first 5 years. I said, man.
Yeah, I think Pac Life has an annuity that I was just mentioning that has zero surrender schedule ever. So it's just like pay as you go. It's like the old C share, if you remember.
Yeah, but you don't want that. You'd rather have if you have other source of liquidity, you actually want your money tied up so that way people can have access to it. But anyway, it's interesting how much a lot of, like Penelope says, a lot of people seem to be stuck in an old way of thinking about annuities. Annuities have changed, man. It's crazy. It's great. Even USA is offering fixed index annuities now. It's crazy.
Investment options. There are a lot of different investment options that you'll find in annuities, right? One of the annuities that have been popular in the last decade is called investment-only annuities, IOLAs. So they strip out all the M&E fees, all the other fees, and you could get just your basic S&P 500 fund wrapped in an annuity for less than 10 basis points, right? So there are different investment options that you can consider. And then the strategy, whether you want a fixed annuity or variable rate annuity, that can be part of it as well. The other thing that we want to get into a little bit is like scenarios where which annuity would make the most sense. So in order to do that, we should have some basic information on what a fixed index annuity is or of the products. So today we're just going to focus on fixed index annuity. So a fixed index annuity basically is a simplified insurance product that provides upside while protecting the downside, right? Yeah. And again, there's two phases: the accumulation phase where it keeps growing, and then there's a distribution phase where you could distribute it from that annuity, which may have old actuarial tables, which may be in your benefit, or you can 1035 that into a new annuity that's more income focused, like a single premium immediate annuity. This, there's some definite advantages, right? A fixed index annuity limits your losses, right? Like you can guarantee your principal through the insurance that the company has. There's possibilities for some basic interest, right? So I've seen some of these index annuities at a bare minimum will pay you the risk-free rate, of 3 or 4%. And then you may have an ability to lock in earnings as it surpasses that over a period of time. So, index annuities will provide you better inflation protection than a CD. And then, like all annuities, these are tax-deferred growth. If you own it in an IRA or 401k, which the Secure Act is definitely adding more protection for annuity owners. So I don't know if you saw in the Secure Act that now annuities are one of the main options, right? So you have your variable piece, and then you have a quasi-pension piece, which is an annuity, right? But if you do have this in an after-tax, if you do have this in an after-tax account, be careful for the 10% penalty if you need to withdraw before.
You saw that, Amar? Pulverizer says he's going to your channel. It's way better over here.
I appreciate that. But
that's funny.
So here's a visual representation of it. And I know it's small, but what you can see here is a dark line that goes up and down. That's like the market. Yeah. Traditionally, index annuities will be a basket of securities, like Apple, Netflix, Amazon, just a bunch of companies that they'll basket together. Or it could be indexes like the Russell, the S&P, the NASDAQ, or it could just be one index, the S&P 500, right? So here what happens is you have an interval period, let's say it's 1 year, and then the manager of the annuity says, all right, do you have more money than you had than where the index was a year ago? If so, then you lock in some value, right? If it's less, then your account value is the old value that you had. So it's kind of taking the stairs, right? You get these step ups over a period of time, right? There are a couple of terms to be careful about because it's not the best thing since sliced bread, right? Because there are some things that the insurance company controls to make sure that they stay profitable, right? So, the loss floor is a term that uses what is the worst case scenario. Most of the time with index annuities, it's 0%. But sometimes it could be -5, -10 to potentially give you more upside capture, right? And so we'll talk about that in a moment. Sometimes there's a minimum return, like we talked about earlier. You could get the risk-free rate, would be the minimum interest paid. And then once the market makes back that amount plus where the market is, then you get some participation in the index. They can adjust the value so there's three things here. There's what is the return cap? So if we're using the S&P 500, and let's say the S&P 500 does 15%, but the cap is 10%, no matter what, you won't get more than 10%, right? The other 5%, that gravy is going to the insurance company to pay its bills, right? There's also a participation rate. So if the market index does, let's say 12%, and your participation rate is 50%, then you get 6%, right?
With a cap too, sometimes though, there could be a cap on that too at 5%. You know what I'm saying? So there's all
and that's really important. So there's three variables, right? They control, right? This is they control the return cap. So let's say that let's use an example. The cap is 10%. S&P does 30%. And let's say your participation rate is 50%. So you take 50% of that would be 15, but if your cap is 10, the max you're going to get is 10, right? And then there could also be what the insurance company calls as a spread or margin or an asset-based fee that you have to pay each year. It's kind of like a percent of your overall assets to protect their ability to write those derivatives to create this product, right? So the underlying investment under these insurance contracts are derivatives, right? So they take roughly 80 to 90%, put it in short-term treasuries, and then the 20% they're buying derivatives to give you that exposure to the market or the index. So there are some downsides too, right? So there's a limit of potential gains, right? This is a conservative approach, right? There's if you want the full risk or full gains, you have to take the full risk, right? There's just no other ways around that. There could be potential of high fees.
Well, hold on a second. Let me just repeat that. Folks, if you want market-like returns, you have to be in the market. You can't have any kind of insurance product or that's just all there is to it. The one thing that irks me about these index annuity pushers is they say market-like returns without the risk, and it's just not true, man. I mean, and that's why, Amar, going back to my guy, who I got nothing but fond respect for, I was like, market-like returns. I said, well, what's the market? I asked him that, and he said, let me look into it. I said, exactly. So, what are we comparing it to? It frustrates me knowing market-like returns without the market risk. You can't have your cake and eat it too here. And there's nothing wrong with that, but I don't like some of these purveyors of these things like spouting off like you're going to give the S&P 500 similar return without the risk. It's just not true. Now we keep going.
Yeah, it's definitely a product that for individuals that want to protect some of their downside, right? So it's not maximizing on the upside. The other things is there could be high fees, right? They have this cap and this participation rate, and some of these participation rates change over time, right? So like they can reduce the participation rate in order to capture some of the losses that they've had in previous years. It's all in the finely printed language on the back of your insurance contract on page 97 that nobody reads, right? So they have levers that they could pull to keep them profitable, right? So and most of that revolves around high fees. Surrender charges, right? if you cancel your contract before the surrender period, you can owe a fee, right? Um, and just like the market, there's some uncertainty, right? You may be better off in a CD or a bond where you know exactly what you're going to get. Here, there is some uncertainty. Over a longer period of time, the odds are you may be ahead, but there is some uncertainty around that.
And no dividends. I've yet to see a fixed index annuity that includes dividends either. That's another. And this is just we're just talking about the negatives, friends. We're not talking about. I mean, there's positives here too, but without the dividends, you're not getting market-like returns if there's no dividends. It's just that simple.
Cool. So the next 10 minutes that we have here, Josh, I think I want to talk about why does this make sense for me, or what should I be thinking about, right, when I'm considering an annuity, right? And so the first thing I think is that if you're doing a financial plan to see how much money you need in retirement and where you are, and you're at the last 5 to 10 year mark before retirement is going to become a reality, an annuity may increase the probability of success, right? And so this again goes to sequence risk. So if you don't have a large cash buffer, annuity can provide protection on the downside to give you those payments. And you can also have a period certain, right, where it's like, all right, for the next 5 years, my income is guaranteed to come from this annuity. And then my investments have a longer period of time to grow, and then I'm going to tap into those later. The second thing is for somebody that's in a high income or has deferred comp or restricted stock units that are in a high tax bracket, this could provide some tax deferral for your other assets, and while you pay taxes on those dollars, and then you can tap into the annuity. Some of the things that have evolved are some of these benefit riders. One of the benefit riders is like a long-term care benefit, right? Exactly. So you can, it's kind of like you have the industry from the days of 35 insurance carriers selling long-term care, and now we're down to 3, right? And so because they've all mispriced the long-term care product, if you will, right? The actuarial tables were totally off. Well, this annuity product allows you to self-insure, but have a leverage on your actual dollars that you have in the annuity if there was a long-term care event. Now, obviously, it's not free, so you got to weigh the pros of the expense versus the benefit, right, which you should do with everything. I think the other scenario where an index annuity or an annuity in general could make sense is it's a great compromise for some people, a compromise of long-term investment growth with the benefit of guaranteeing against steep losses, and oftentimes as an advisor, we come across clients or potential clients or what have you that have the ability to be swayed by what's going on in the current markets, the current environment, the current news channel, cycle, presidential election, etc., and they'll go all or nothing. Well, this is a great compromise because it keeps you invested and it gives you the peace of mind that your money is protected against steep losses. And then lastly, for those that are retiring and trying to live the best life possible, but also want to protect against longevity risk, I mean, the second part of an annuity in the distribution phase, you can get guaranteed payments for a period of time or a lifetime, or you and your spouse's lifetime, right? Just like a pension. So if you're trying to maximize every dollar spent through a period of time, this could be a good way to say, from an actuarial basis, this is how we can do it, and to maximize that. And so there are many things in an annuity product that have changed over the years, and it may be worth revisiting. Again, myself, I'm an advisor.
Are you done with the slides?
Yes. Okay, yeah. As an advisor, I mean, again, we're not a commission-based firm. We're a fee-only firm, which, I don't have anything against people that sell annuities for commissions, but I think there's a segment of population that's very conscious about the commission piece. And so we're not that, and we can help you explore options. So, Josh, do you mind if I take 30 seconds to just do a little commercial, and then we can answer
Yeah.
questions?
Oh,
Yeah.
means. Absolutely.
So I saw in the chat that Marie was asking about what my YouTube channel is. We have a Client First Capital Learning channel. It's a YouTube channel. We try to put a video a week up there. It's very
Yeah, you just did
informative.
an interview with some guy about the 5 risks of retirement planning or something like that, didn't you?
Yeah, our old, I don't know if he was your boss, but Kerry Smith works with us as well. Kerry Smith was based out of the USA office in Phoenix, and I think he worked at USA for 30 years. But anyways, he used to be my boss, and somehow I convinced him to after he retired to help me out and grow our presence.
And you do some estate planning interviews too. So, well, here, you tell them again your
Yeah,
YouTube channel.
yeah. So I mean, we work with industry professionals. We try to create some content, not long form. It's usually 10 to 15 minutes or less, and we cover income taxes, estate planning, investments, and charitable giving. So if any of those are important to you, please visit our channel, subscribe. We also have a newsletter that comes out once a month. It's only 11 issues. So if you'd like to read content, then that's a good way to get that content. And then lastly, you can visit our website, which is clientfirstcapital.com, clientfirstcap.com, and you could reach out to us directly. It has our phone number right on there, and happy to help.
Yeah, right. And just I got to be careful what I say, but Amar is a CFA and a CFP, and so it's not. I know he looks like he's 10 years old, but that's some pretty good chops there. I'm not recommending, can't do anything like that. But I'm just saying there's not too many people that got that skill set for a guy who has done both the CFP and the CFA. And Amar, I get a lot of people say, should I do the CFA or CFP? I said, if you want to kill yourself, do the CFA. If you don't want to kill yourself, do the CFP. It's just that simple.
Yeah.
Is there a simple explanation of annuity options on your website, Amar, says Dwayne. Now, Dwayne's a Georgia Tech grad, Amar, so you got to be sucked very slowly to him. Very slowly.
So we don't have a section that's dedicated to annuities. I'm an investment manager. I mean, part of my role is actively managing funds. So, annuities is a thing that we do for the clients that want that type of protection, right? We're not looking for clients that want annuities directly, but if you want that type of protection, we can help. The other part that we come across a lot is people have old annuities and they don't know what to do with them, and they don't know what fees they're paying on them. And so, we can kind of do some analysis and say, wow, you have this large gain. It would not make sense to sell it and get that cash in a taxable account for us to manage, right? That'd be the worst thing you should do. Well, what are some solutions that you can do with the options that are out there? So really, we're just it's part of the financial planning puzzle, and we're here to help.
And I think the old mortality tables too, I think that's something that's hugely overlooked. If you have an older annuity that you sign up when mortality tables are different, when people were like, I guess it's changed now because people are dying earlier. But anyway, the older ones, like in the 90s, the mortality table had you basically living until you're 74 or something like that, whatever it is. And I tell you, Amar, that gets so overlooked. And a lot of people exchange out their annuities for a better product, not realizing what they had was, you can't shake it. And I don't want to get too deep in that. But man, I tell you guys, if you have older annuities, don't just cash them in willy-nilly, because I used to do this when I was at USA. We'd run an annuity income stream based on the mortality tables from the annuity they took out in 1980 or 1990, whatever, and we compare it to the current mortality tables. And we're talking 30 to 40% more income on those older annuity contracts that they had, because they had it based on their life expectancy was much, much shorter. And you're not going to find that anywhere else. That's the nice thing about Amar, and I got to be careful what I say. Having come from USA, we were paid to know stuff, not paid to sell stuff necessarily. And we still had goals to meet all that. But generally speaking, we were the best financial planners out there because we were paid to know stuff that other people did not know. And I tell you, man, you could really dive deep in various products and strategies that you can't do if you're like a producer where you're out there trying to beat the bushes. And it was just great. So.
Hey, Josh, Bruce has a good question here. Bruce 67.
Hey, Bruce. Yeah. I call him Beardsley Bruce. Yeah.
So, I mean, the way that we look at it, everybody has
Well,
their
let's,
own
let's
thought.
let's ask a question. So, wife will get half of a decent pension. We both have Ross, 401ks, and Social Security. Is annuity something to look at if you have a pension? All right, there you go. That's a question.
Right. So, and then I think maybe we can end on this question, because I think this is a good way to kind of summarize why an annuity may make sense. If you have the first step I would do is detail your essential expenses. If you look at your essential expenses, how much of that will be covered from pensions, Social Security, or anything that's guaranteed in nature? And then see, where do you feel comfortable? If it's covering, 30% and you want to be more conservative, then an annuity may make sense to cover some of that gap. But if it's covering 60 to 70%, you may not need an annuity, because you're already covering a bulk of your essential expenses through a guaranteed source.
Real quick, Amar, if you got to jump off, that's fine. But my man Michael Lewis, who wrote the book Moneyball, he says, I've been researching fixed index annuities, and the part I have difficulty with is their ability to change, is what Amar was talking about earlier, the cap, participation rate, and spread. I 100%, Michael, that's a big concern I have, because frankly, I don't trust any of these guys. That doesn't mean they're bad. I just man, I see that ability to change it after the contract's been signed. I'm like, that creeps me out a little bit. Anything to add to that, Amar, by chance?
Yeah, I mean, they have to stay profitable. So I would just bet that they are going to change it, not in your favor, right? And so, so the question becomes, would you be willing to take on the risk yourself? Because you can do the same thing, right? You could build on.
That's a great point.
You can buy S&P 500 options or LEAPs for 20% of your money and keep 80% of it in a treasury yielding 5%. Over X amount of time, you'll have either your principal back, or you'll have your principal plus a lot of money through those LEAPs or options, right? So the annuity, the benefit is that it pools that risk with many other people, right?
Yes.
So it's spreading that cost, right? Whereas if you do it yourself, you're taking on all that cost and risk.
And Fulbright says, Dad's got 9 years old, still getting a little bit of money from an annuity. That's what I'm pro annuities. I like them, and I'm actually even pro fixed index annuities. I just I don't like the way the sales part presentation is a lot. Anyway, Amar, you got to jump off. I'm going to hang out and just see if anyone else has any questions. If you need to jump off, Amar, I enjoy doing the live streams. Actually, it's fun. But
yeah. I mean, I got 5 minutes. That we can chat here. If anybody has any questions that we could.
Let me just add too. I think real quick, the guy from Roger Ibbotson, the guy who does the SBBI, the stocks, bonds, bills, and inflation. Ibbotson. He said index annuities are a replacement for bonds. All right. And that's Ibbotson. That's like that he's University of Chicago. He's been around for a long, long time. So when I hear people talking about the market-like returns, I think to myself, well, Ibbotson is saying bonds as a replacement or a complement, not stocks. And that's the issue that just is like, I actually think annuities and these fixed index annuities have a place for the income stream that you can't outlive, for the no losses on the downside, but they're a bond replacement, not a stock replacement. And that's I just wish more people would understand that.
So if you had a 50-50 portfolio and 50% were in stocks and then 50% was in bonds, maybe you carve out half of those bonds, right? And you have 25% in bonds, and then you have 25% in a fixed index annuity to get you that, or a fixed annuity where you get a guaranteed interest rate. Oftentimes the problem with bonds is that the markets have been so correlated between stocks and bonds. So when you see a large dip in stocks, you're also seeing a similar dip in bonds. And the real reason I believe that is that a lot of these companies have a ton of debt on their books, right? So once their profitability goes down, their likelihood to pay those debt instruments also goes down quite a bit, right? So like there's this term profitless companies, right? Like something like 30% of small cap companies are profitless, meaning that they're just making enough income to pay their debt holders, right? Now, over time, they can get more market share, and then that market share could add value to the company. But if you have that much debt on your books, I mean, that is concerning, right, from a investment standpoint. And so the ability to carve out some of the downside risks that are in bonds, right? Like if you Google like the 30-year Treasury, which is TLT, right? There is variability in that.
2022, the worst bond market ever. I mean, no one walking the face of the earth have ever in the United States seen a bond market like we saw in 2022. Yeah. Annuities didn't have that downside risk, Amar. You know what I'm saying? All these annuities, they suck. I'm like, what did your bonds do? Oh, yeah, they got crushed. Yeah. And what have they done since? I have some long-term government bonds. I think that market will change. I absolutely could be wrong. In the interim, annuities just go flat or up. That's it. Flat or up.
Yeah. And if that helps you sleep at night and it allows you to focus on having the best time in retirement, then it's I think the trade-off is good for that type of individual.
Yeah, right on. All right, well, good stuff, Amar, and we'll be back. So every 2 weeks, Amar and I jump on board. If you guys got suggestions, it's probably easy to put them on Amar's YouTube channel just because he has less. I know I don't like to sound like this, but he just has less comments. It'll be easier to see if that makes sense. But
yeah,
if you guys suggest, and Amar's the guy who's doing the grunt work, but here's the one coming up the slides, and we both have ideas, but Amar's the guy doing the grunt work. I just take care of these freaking knucklehead dogs here who can't sit and got ants in their pants. But thanks, Amar. Your channel's way nicer than the Scandlens. Yeah.
And what do you call it? The next one we're going to talk about is benchmarks. I think I saw one comment in here around benchmarks. Yep. We're going to do a little bit of a deep dive into benchmarks. Like, what is an appropriate benchmark? What should you be benchmarking against? Why even have a benchmark?
Because if you don't have a benchmark, you have nothing to compare. That's the thing. Like the market for you is different than me from the market than what I think. Not you, Mar, but you know what I'm saying? The benchmark. And then are people changing their benchmarks midstream? That's another thing that ticks me off. So a lot of things tick me off, actually. It's weird. I get ticked off a lot. I'm not sure why. But all right, Mar, we'll get you out of here. I'm going to get these knuckleheads outside. God bless. Thanks for being here, y'all. Stop.
Thank you. Bye.
Thanks, Mar. We'll see you, man. Stop.